Are we starting to see year-over-year price declines in the Omaha market? What's going on with interest rates? What about inventory? These are the questions we're going to be answering in this week's videos, and we're going to get started right now. Let's talk home prices. In Douglas and Sarpy County, the median closed sales price for the month of July was $320,219. That is a year-over-year decline of 0.9%. Remember, the real estate market is a local market. Every market is going to be different. For example, if I were to compare Douglas versus Sarpy County, in Douglas County, we had a 1.9% decline year over year for the month of July. In Sarpy County, we had a 6.8 increase year over year for the month of July. For anyone not from the Omaha area, Douglas County contains the city of Omaha, along with a few smaller towns, which include Ralston, Bennington, Waterloo, and Valley. Sarpy County is south of Douglas County and contains the cities of Bellevue, Papillion, La Vista, Gretna, and Springfield. Remember, the purpose of my market updates is to give you a general idea of the overall market in the Omaha area. If you were buying a home, you want to drill down and look at the subdivision level and compare individual homes by comparison shopping. Keep in mind, the smartest person in the transaction is a buyer. And why is that? Well, the buyer is out in the marketplace comparing homes. After seeing a property in person, a buyer can readily determine if that home is priced right or not. A properly priced home readily stands out in the market compared to the competition. At the same time, an overpriced home does the same thing. No amount of marketing can sell an overpriced listing. Many sellers fail to realize that 90% of marketing is price. If you're in the market to buy a home, you need to be aware of a new change effective August 17th. As of August 17th, if you want to tour a home with a buyer's agent, you will be required to sign a buyer-broker agreement before you tour a property. Now, if you sign a buyer-broker agreement, be sure to read it and completely understand your obligations concerning that agreement. What about the prices of new versus existing? In Douglas and Sarpy County, the median sale price in July for a new home was $419,990. This is down 6.9% compared to July of 2023. For existing homes, the median sale price for an existing home was $300,000, which is the same as it was a year ago. Let's look at home prices over the last 10 years. The green represents new construction and the red represents existing homes. When we look at the month to month, the line is very jagged because month to month, we tend to see more variation. If we look at each data point as a rolling 12-month average, it smooths out the line. You can see where in red we have a steady increase in price over the past 10 years. However, with new construction in green, we've seen the price of new construction go down. Now, does that mean the new construction market is crashing? No, not necessarily. Builders adapt to the marketplace. Builders want to make money. And if they make a slightly smaller home to adjust to the marketplace, they will. Looking at this data, we have seen that prices in the new construction market have come down since the peak of July of 2023. Let's talk about inventory. The number of homes for sale was up 35.1% compared to July of 2023. We have a total of 2,021 homes for sale in Douglas and Sarpy County. Again, more choices is good for buyers. Let's compare new versus existing in terms of inventory. For new construction, we have had 964 homes for sale. Inventory was up 17.4% for new construction compared to 2023. For existing homes, we have 1,057 homes on the market. For existing homes, inventory was up 56.6% compared to 2023. Let's look at closed sales. The number of homes closed in the month of July of 2024 was 995. In 2023, we closed 994. Essentially, we closed the same number of homes as 2023. Let's look at home prices over the past 5 years in Douglas and Sarpy County. When you look at the median closed sales price month to month over the past 5 years, you're going to see month to month fluctuation. For example, the price of homes tends to peak in the month of June of every year. That is why it's best to look at prices on a year over year basis. Month to month, we can have some wide variation. And also, there is a seasonality to the marketplace. During the summer months, larger homes tend to be purchased. So you're going to see each year the price of homes peak in the summer months. It decreases in the fall, bottoms out in the winter, and then ramps back up and again in the spring.
Many buyers try to time the market because they want to know when is the best time to buy. The best time to buy is when you're ready. Is the market going to crash? Nobody knows. Actually, the best time to buy a home was 10 years ago. The next best time is today. If you can afford it, that's the problem, affordability. Now, when you compare home prices to other markets, Omaha is much more affordable. But unfortunately, home prices are still unaffordable for many buyers. I've been selling real estate for over 20 years. 5 years ago, a well-qualified buyer who was single with a good paying job could afford to buy a home in the Omaha market. Today, first-time buyers are often married couples well into their mid-30s and both have really well-paying jobs. And that's just the result of inflation, the loss of purchasing power and the value of the dollar. Now, will home prices go down? It's going to depend on the market. Builders are in the business of making money. Instead of losing money, builders will simply lay off workers and build fewer homes. You might see some price reduction in the new construction market, or builders will adjust to the market and build a home with a smaller price. However, just to get to the ground where builders can build takes close to $100,000 just to develop the ground to lot stage. One solution is to build more townhomes or row homes. 10 years ago, a buyer could afford to buy a 3-bedroom, 2-bath, 2-car garage for around $175,000. Today, that same starter home is above $300,000. Now, there's no easy fix to this. I know some people out there who are thinking that they will wait for prices to come down 30%. Now, that could happen in other markets, but 4 years ago, I had buyers who thought prices had to come down, so they decided to wait back then. And guess what? They're still waiting. Affordability has 3 components: the price of the home, the payment, and your income. Here's the problem. Prices of homes have gone up and the payment has gone up and incomes have remained the same. During the pandemic, interest rates were so low that affordability wasn't the problem. The problem was lack of inventory. They solved the inventory problem. Inventory is up because nobody can afford to buy a home. Now, here's another just a fair warning. Be ready for insurance to go through the roof. The recent storms we have seen, insurance is about to go crazy. We're talking $5,000 a year for a $300,000 home in the Omaha market. Be sure to plan and budget accordingly. Let's talk interest rates. One of the components of affordability is interest rates. Good news, interest rates have gone down. According to Mortgage News Daily, the 30-year fixed rate mortgage is 6.56%. Just a few weeks ago, interest rates were well above 7%. When rates go down, it means buyers have more purchasing power. Why did rates go down? About a week ago, we had a weak jobs report. Jerome Powell and the Federal Reserve are trying to do 2 things at once. Number 1, keep inflation under control, and 2, maximize employment. When inflation increases, the Fed increases the federal funds rate. The Fed funds rate is the rate banks charge each other when they borrow money. The Fed is trying to slow the economy. Now, if jobs are lost and unemployment goes up, the Fed will lower interest rates in order to stimulate the economy. We had a weak jobs report, so the market is anticipating the Fed will lower the Fed funds rate. The Fed funds rate influences mortgage interest rates. They're not directly related. The Fed does not control mortgage interest rates. Mortgage interest rates are tied to the 10-year Treasury yield. If you're an investor, you could invest in U.S. Treasuries and earn a return of 4% with zero risk. In order to entice investors to invest in a pool of mortgages, you would have to offer a higher rate because mortgages have higher risk, because somebody could default. So actually, bad news of unemployment increasing is actually good news if you're in the market to buy a home. Speaking of unemployment, the U.S. unemployment rate was up to 4.3% compared to 3.8% last year. Locally in Douglas County, the unemployment rate was 3.4% compared to 2.7% last year. In Sarpy County, the unemployment rate went up from 2.4% in 2023 to 3.2% in 2024. Locally, it was announced that Kellogg's is planning to close their plant in Omaha in 2026. This will result in the loss of approximately 550 positions. Is there any reason to panic? No, it's unfortunate, but that's the nature of business. And thankfully, in the Omaha market, we have a very diverse economy in our local market. Let's look at the inflation numbers. Another reason the Fed may decide to lower interest rates next month is because we're starting to see better numbers when it comes to inflation. We continue to see improvements with inflation. In July, the inflation rate was 2.9%. That is the lowest it has been since March of 2021. The Fed is trying to slow the economy enough without slowing it too much and throwing us into recession. Now, all this happy talk about inflation going down is great, even if the inflation rate is at the target rate of 2%. That does not mean home prices are coming down from where they are now. Let's shift gears and talk about lumber. As rates dropped, the housing market got some good news, which means lumber went up. Lumber dipped in mid-July to $422 for 1,000 board feet. As rates dropped, the lumber market bumped up to over $529 for 1,000 board feet. That means the lumber market was anticipating more demand for lumber and thus an increase in prices.
Let's shift back and look at the days on market. Homes are on the market longer. The average days on market in July was 19 days on the market, which is up 11.8%. Let's take a moment and look at new versus existing. The average days on market for a new construction home was 61 days on the market. For existing homes, the average days on market was 10 days. What about months of supply? For July, we have 2.3 months of inventory. That means if no other homes came on the market, it would take 2.3 months to exhaust the current inventory. If we compare new versus existing, we have 6.6 months of inventory in the new construction market, and we have 1.5 months of inventory in the existing market. Remember, 0 to 3 months is a seller's market, 4 to 6 months is a neutral market, and over 6 months is a buyer's market. So what we have is we have a buyer's market in new construction, and we have a seller's market in the existing market. Let's talk about price per square foot. In the green line, we have new construction, and the red line represents existing. If we look at the last 10 years and look at the rolling 12-month average, where each data point represents 12 months of activity. For new construction, we're looking at $254 a square foot, and for the existing market, we're looking at $206 a square foot.